Welcome in our market master, Prateek Gupta is now joining us. He's Chief Executive Officer and Co-Head at Kotak Institutional Equities. Prateek, good morning. Good to have you with us here. Thanks very much for your time. The trickle of disappointments, I'm not sure whether it is a little longer than surprises. It's either meet or disappoint. I mean, are there big surprises on the upside? Bajaj was one. I mean, maybe Polycab was another. And maybe I'm surely missing a few, but does it look like more disappointments this time around?
Hi, good morning, Prashant. Yes, I think by and large, the earnings season has been sort of in line or below expectations, as you said, barring a few exceptions. I would add amongst the large caps, Reliance Industries is one of the better ones. But by and large, we haven't seen a broad-based upward earnings revision for FY24 or FY25 here at Kotak, and we cover almost 250 stocks. The earnings performance has been, by and large, sort of not. In fact, I would call it a bit below expectations, given where the multiples are. You generally need earnings upgrades to keep these multiples going, and in fact, to drive stock prices higher. And that's just not come through this earnings season. And the economy is still sort of, it's a slowish recovery.
But tell us a little bit about how you're approaching the markets, given that there are these global, these geopolitical issues. There is a bit of FI selling as well. Are you turning a bit cautious now?
Sonia, hi. Actually, at Kotak, we've been cautious for a while on the market last several months. And unfortunately, the market hasn't done much. If anything, it's come off a bit more. Geopolitics is definitely a new concern, which wasn't there a few months back. So that does pose more downside risk, especially if the conflict escalates. And that results from an India perspective. One is overall equity risk premium globally coming off. And second is, or risk appetite coming off. And the second is oil prices going up, which obviously would impact India quite adversely. And keep in mind, this is happening at a time when India's valuations are still, we're not a cheap market. We're still almost 18 times. The Nifty is 18 times March 25 earnings. So we're not sort of cheap. We're just about middling kind of valuations. And then on top of that, you've got a slowing global economy, downside risks to all the export-oriented companies' earnings. You've got a slowish recovery in the domestic economy. You've got the private capex cycle, which hasn't really taken off in full steam as yet. And you've got the prospects of slowing government capex, given the fiscal pressures which are out there. So in that context, the risks are more skewed to the downside. At the same time, I would caution against being overly bearish also, given that we still have a lot of domestic flow, domestic savings, which are coming into the equity markets in India. And that's helping to offset the foreign selling, as we've seen in the month of October. In October, we've seen about 25,000 crores worth of foreign selling, and that's been reasonably well absorbed. The markets come off barely 3-4% or so. So we won't be overly negative unless the geopolitical situation really worsens, or the other risk is you get a surprise rate hike from either the US or the Bank of Japan over the next few months.
Okay, all right. Hi, Prateek. Good morning, and good to have you on the show. The last time we chatted, I think we briefly chatted about autos, and I think auto ancillaries was something that you're a little bit enthused about. What's your view now out there? We're getting some numbers that are coming in there, and they're not looking too bad, but we'll have to wait by to see how festive season is panning out. Your take?
So on auto ancillaries, most of them, unfortunately, are more global oriented in nature. So given, the impact of the rising bond yields and interest rates globally, both in the US and Europe in particular, which are the main end markets for most of these auto ancillary companies, which are exporters, I think it's time to be a little bit cautious, and also partly keeping in mind the run-up in the stocks over the last few months. So in general, we would be a bit cautious, and we would prefer some of the domestic-oriented OEMs instead, and that too more in the commercial vehicle segment or something. But in general, the auto space, we would be somewhat cautious at current valuations.
Okay, cautious at current valuations. By the way, Escorts numbers also are looking quite weak this time, actually. Just pull up Escorts Kubota. The total sales are down almost 9% year on year, coming in at 13,200 units, while domestic sales are down 8.7%. And the management says that this festive season, this year was delayed and spread across 2 months. Hence, October sales were slightly muted compared to last year. November, however, looks positive with key festivals in the first half of the month, and all macroeconomic factors remain positive. So they are quite optimistic going forward, but this month's numbers were muted because of the delay in the festive season. Pratik, how are you feeling about the financials now? We've had some good quality numbers come in from private sector banks this time. We have, some big PSU banks coming out with numbers this week. How are you feeling about it?
So we still like the banks, although they haven't done as well. But that's one of the reasons we like them now at current valuation. The valuation is indeed quite attractive, and we are still far away from a uptake in credit costs in a big way. That is probably still 1.5, 2, 3 years away. So in that context, the private banks, which have a strong liability franchise, they in particular look pretty attractive to us. Although, given the increasing risks to the market and the global economy and oil prices, etc., our preference would be now to shift more towards the safer banks, which is mainly the large, private banks, and maybe the top 1 or 2 state-owned banks. Earlier in the year, say 6-9 months back, we were actually more positive on the mid-tier private banks, some of the PSU banks. But I think it's time to switch and get back into the more of the front, the leading private banks and 1 or 2 of the top PSU banks, just given the increasing risks out there. And also from a valuation angle, perspective, the top private banks have actually not performed, so their valuations have come off. They're looking far more attractive now.
Do capital goods stocks like L&T seem attractive to you even at these levels, despite the kind of run-up that we've seen in these stocks?
In the long term, yes. Although in the short term, you got to be a little bit cautious given the government capex, which is perhaps unlikely to be sustained. The kind of government capex which has been going on for the last few years. And just bear in mind, once the elections are over, any new government will have to start moving towards fiscal consolidation, given the FRBM mandate a couple of years down the road. So inevitably, you will see fiscal consolidation, which will limit the headroom available for an increase in government capex. So that's more of a longer-term issue. But structurally, from a 3 to 5 year view, we still like it. The short term, we would be a little bit cautious.
Just pull up Idea. Idea is up about 6% or so, 12.5 odd rupees. I mean, it's done well recently, that is. So keep an eye out on that one. And the other one, I mean, in these, names which have been troubled business-wise, etc., over the last many years, Jayaprakash Associates is another one. Our colleague Ritu reported that ICICI Bank and the company Jayaprakash Associates, ICICI Bank is the lead banker, one of the lead bankers along with SBI for JP. They're in talks to try and resolve the debt issue outside of the NCLT process. And I think there is a hearing later in the month of November. So keep an eye out on that one as well. So both these have been doing well. The other one is Bombay Burma, 7.5% rally, huge volumes coming through. Stocks at about 1450, 1453 as things stand right now. Pratik, any idiosyncratic opportunities as you see it? I mean, as you said, you have a 250 stock coverage universe. I'm sure there is money to be made in absolute sense, even as you're overall cautious. What are your top ideas, absolute return perspective?
Firstly, in the short term, very little. We are really scratching our heads for investment ideas in the very short term. You have to have a slightly longer term perspective, more than 1.5, 2 years at the very least. But from that angle, we do like I said, our top ideas at current valuations, plus given where we are in the economic cycle, the markets where we are, still remains the private banks. The large 3 or 4 private banks, in our view, look extremely attractive at current valuations. Credit costs are low, loan growth is decent. They have a strong liability franchise. NIMs are going up, but not by so much. So ROEs are still going to be quite attractive, and they're extremely well positioned to benefit from an increase in both the private capex cycle as well as in residential mortgage as the residential cycle also picks up. So that's one. And the second is some of the real estate plays where we think interest rates are probably close to peaking out, maybe another 25, 50 bips at most in the next 6-9 months. And gradually you're seeing the consumer recovering, the consumer sector. So, gradually you will see the real estate, residential real estate sales in particular doing quite well. So these are the two segments where we see pockets of opportunities over a slightly longer term time frame. But bear in mind, there are obviously the overall market-wide risks in the short term, which I pointed out to geopolitics and central banks raising rates and so on. But those are more short term in nature.
Okay, got it. Thanks a lot, Pratik, for joining in. Have a great day and a good week. That's Kotak Institutional Equities with their view on the markets.